Greetings, everyone. The market has been incredibly active lately, as I'm sure you've noticed. Just this week, the VIX, a key measure of market volatility, soared past 65. To put that into perspective, it's only the fourth time in the last 40 to 50 years that we've seen such a dramatic spike. We're talking levels comparable to the 2008 financial crisis, the dot-com bubble burst in 2000, and even the market crash of 1987. Now, what does this volatility tell us? It often signals a significant shift, a cathartic moment in the market where things are changing and changing fast. For a while now, we've been talking about the U.S. economy and potentially the global economy going through a kind of rolling recession ever since the Federal Reserve started raising interest rates. Here's another piece of the puzzle that was unfolding behind the scenes, a surge in what's known as the carry trade. Investors were essentially borrowing Japanese yen at extremely low interest rates, effectively shorting the yen, and then using those funds to buy U.S. dollars. Why? To invest in higher-yielding assets, primarily in the U.S. market. It was a strategy that capitalized on the interest rate differential between the two countries. This trade became even more popular because the Japanese yen had been weakening against the U.S. dollar, meaning anyone shorting the yen was profiting from that depreciation. However, this strategy backfired dramatically this week. The Bank of Japan unexpectedly raised interest rates more aggressively than anticipated, and signaled its willingness to continue these rate hikes. This sent shockwaves through the market, triggering a wave of margin calls, demands for investors to increase their collateral, and forcing many to sell off assets, including U.S. stocks, to cover their positions. This sudden unwinding of the yen carry trade was a major contributor to the recent volatility surge. While the VIX has settled down somewhat, J.P. Morgan, a leading financial institution, estimates that we're only halfway through the unwinding process. This suggests we could see more volatility ahead. However, I believe this situation has put the Federal Reserve on high alert. For months, the relative strength of the stock market seemed to embolden the Fed to keep interest rates higher for a longer period, aiming to completely eradicate inflation. We've consistently maintained that inflation is cooling down much faster than traditional indicators suggest. The Consumer Price Index, CPI, currently stands at 3.1%, but alternative metrics reveal a more rapid decline in prices. We anticipate further price drops as consumer spending weakens. Why this expectation of weaker consumer spending? Because corporations are starting to lose their pricing power. To protect their profit margins, they'll likely resort to two strategies: layoffs and increased automation to boost productivity. These measures, while potentially beneficial in the long run, will lead to higher unemployment, a development that's finally making the Fed reconsider its aggressive stance. Let's not forget the impact on Chairman Powell and other high-net-worth individuals who are personally feeling the sting of the stock market decline. This factor further incentivizes the Fed to ease up on its rate hikes. Now, it's important to understand that while lower interest rates should generally be positive for the stock market, they won't magically and instantly reverse a recession. Here's why. If consumers and businesses sense that interest rates and prices are poised to decline, they're more likely to hold back on spending and investments. Why buy something now when it might be cheaper later? This delayed gratification effect can prolong the economic slowdown. However, the market, in its collective wisdom, likely already understands much of what I've just outlined. This leads us to believe that as the unwinding of the yen carry trade runs its course, lower interest rates will become the dominant force in the market. We anticipate a rotation away from the narrow group of stocks that have driven the market's gains, primarily in the technology sector, towards a broader range of stocks representing various sectors. Remember, innovation thrives on solving problems. As artificial intelligence, AI, becomes increasingly integrated into the global economy, we foresee significant productivity gains. This current market turmoil, while unsettling, is often a catalyst for change. It forces a reassessment of strategies and priorities. Based on our years of experience navigating similar periods of volatility, we believe this moment marks a transition to a new way of thinking about the markets and the economy. Keep a close eye on these developments as they unfold throughout the rest of the year. Now, let's delve deeper into some of these key concepts and connect them to real-world examples. We'll start with understanding market volatility, explore the mechanics of the yen carry trade and its unwinding, analyze the interplay between inflation, interest rates, and consumer behavior, and finally discuss how technological innovation like AI can drive productivity and shape the future of the global economy. Understanding market volatility. The stock market is inherently a complex system, influenced by a multitude of factors such as economic data, geopolitical events, investor sentiment, and even unforeseen events like pandemics. Volatility, simply put, is the degree to which asset prices, in this case, stock prices, fluctuate over a given period. High volatility implies large and rapid price swings, while low volatility suggests more stable, gradual movements. The VIX, which we mentioned earlier, is often referred to as the fear gauge or fear index because it tends to spike when investors are anxious or uncertain about the future. Think of it like this. Imagine you're sailing a boat on the ocean. Calm waters represent low volatility. The boat glides smoothly with minimal rocking. Suddenly, a storm hits, bringing strong winds and choppy waves. This is akin to high volatility, where the boat gets tossed around unpredictably. Now, in the context of the recent market events, the surge in the VIX indicates that investors are experiencing a storm of uncertainty. The unexpected actions of the Bank of Japan, the unwinding of the yen carry trade, and the potential for further rate hikes by the Federal Reserve have all contributed to this choppy market environment. The yen carry trade, a high-risk, high-reward strategy. To fully grasp the significance of the yen carry trade unwinding, it's essential to understand how this strategy works. Essentially, it leverages the difference in interest rates between two currencies, in this case, the Japanese yen and the US dollar. For many years, Japan has maintained ultra-low interest rates, close to zero, in an attempt to stimulate its sluggish economy. Meanwhile, interest rates in the US, while still historically low, have been higher than in Japan. Imagine you're an investor seeking higher returns. You notice this interest rate differential and devise a plan. You borrow Japanese yen at a very low cost due to Japan's low interest rates and convert those yen into US dollars. You then use those dollars to invest in assets that offer a higher yield, such as US Treasury bonds or stocks. This is the basic premise of the carry trade: borrowing in a low interest rate currency and investing in a higher interest rate currency. As long as the interest rate differential remains favorable and the exchange rate between the two currencies remains relatively stable, you profit from the difference in interest earned and interest paid. However, this strategy comes with significant risk. If the exchange rate moves against you, in this case, if the yen strengthens against the dollar, your profits get eroded and you might even incur losses. Remember, you eventually need to repay your yen loan, and if you have to convert more dollars back into yen to do so, your returns suffer. The recent market volatility stemmed from the Bank of Japan's unexpected move to tighten its monetary policy, signaling a potential end to its ultra-low interest rate regime. This unexpected shift led investors to anticipate a narrowing of the interest rate differential between the yen and the dollar, making the carry trade less profitable. As a result, many investors scrambled to unwind their positions, selling off dollar-denominated assets and buying back yen, which put downward pressure on stock prices and increased market volatility. The inflation puzzle, reading between the lines. Inflation, the rate at which prices for goods and services rise over time, has been a persistent concern for policymakers and investors alike. Central banks like the Federal Reserve try to manage inflation by adjusting interest rates. When inflation is high, they tend to raise interest rates to cool down the economy and curb spending. Conversely, when inflation is low, they might lower interest rates to encourage borrowing and stimulate economic growth. However, accurately measuring inflation and anticipating its future trajectory is a notoriously difficult task. The Consumer Price Index (CPI), while widely used, is just one measure of inflation, and it doesn't always capture the full picture. For example, the CPI might not fully reflect the rapid price increases we've seen in certain sectors like housing and used cars. Furthermore, There's often a lag between policy changes and their impact on the real economy. It takes time for interest rate hikes to filter through the system and affect consumer and business behavior. We've been arguing that inflation is actually cooling down faster than the official CPI figures suggest. This viewpoint is based on several factors, including supply chain improvements. The global supply chain disruptions that contributed to price spikes during the pandemic are gradually easing, leading to lower transportation costs and improved product availability. Shifting consumer spending patterns. As the pandemic recedes, consumer spending is shifting away from goods and towards services. This rebalancing can help alleviate inflationary pressures in the goods sector. Base effects. Some of the high inflation readings we've seen are partly due to base effects, where current price increases are compared to relatively low prices from the previous year when the pandemic was at its peak. While the Fed has been laser-focused on combating inflation, the recent market volatility might be a sign that they've gone a bit too far, too fast. The unwinding of the yen carry trade and its potential impact on global financial markets could force the Fed to reconsider its aggressive stance and potentially slow down or even pause its interest rate hikes. Remember, the Fed's mandate is not only to control inflation, but also to promote maximum employment and stable prices. If they push too hard on raising rates, they risk tipping the economy into a recession, which could lead to job losses and further economic instability. The AI revolution, a productivity powerhouse. Now let's shift gears and talk about something a bit more optimistic, the transformative potential of artificial intelligence, AI. As we've witnessed throughout history, technological innovation is a powerful driver of economic growth. Think about the impact of inventions like the steam engine, electricity, the automobile, and the internet. Each of these breakthroughs led to significant productivity gains, improved living standards, and created entirely new industries. We believe AI has the potential to be just as transformative, if not more so. AI, in its simplest form, refers to the ability of machines to perform tasks that typically require human intelligence, such as learning, problem-solving, and decision-making. Here are just a few examples of how AI is already revolutionizing various sectors. Manufacturing. AI-powered robots and automation systems can work alongside humans to improve efficiency, precision, and safety in factories. Healthcare. AI algorithms can analyze medical images, diagnose diseases, and develop personalized treatment plans, potentially leading to faster and more accurate healthcare delivery. Finance. AI-driven trading algorithms can analyze vast amounts of data to identify investment opportunities and manage risk, making financial markets more efficient. Transportation. Self-driving cars, powered by AI, promise to make transportation safer, more efficient, and more accessible. As AI technology continues to advance and become more integrated into various aspects of our lives, we can expect to see significant productivity gains. These gains will stem from several factors. Automation. AI can automate repetitive or dangerous tasks, freeing up human workers to focus on more complex and creative endeavors. Optimization. AI algorithms can analyze data to optimize processes, reduce waste, and improve efficiency in various industries. Personalization. AI can tailor products, services, and experiences to individual preferences, leading to greater customer satisfaction and increased demand. The widespread adoption of AI is not without its challenges. Concerns about job displacement, ethical considerations, and the potential for misuse are valid and require careful consideration. However, history has taught us that embracing technological innovation while navigating its complexities responsibly is essential for long-term economic progress and societal advancement. In conclusion, the recent market volatility serves as a reminder that the global economy is in a constant state of flux, influenced by interconnected factors ranging from monetary policy decisions to technological disruptions. While the unwinding of the yen carry trade and the potential for further interest rate hikes by the Fed have injected a degree of uncertainty into the market, it's crucial to maintain a long-term perspective. We believe that as inflation continues to moderate and the Fed adopts a more balanced approach to monetary policy, the stage will be set for a healthier and more sustainable economic expansion. Furthermore, the ongoing AI revolution, while presenting its own set of challenges, holds immense promise for driving productivity growth, improving living standards, and creating a more prosperous future. Thank you for tuning in to our podcast today. We hope you found this deep dive into the current market dynamics and the transformative potential of AI insightful and informative. If you enjoyed this episode and found it valuable, please don't forget to like, share, and subscribe to our channel for more thought-provoking discussions on finance, technology, and the global economy. Until next time, stay informed, stay engaged, and keep learning.